Hi, everyone. Welcome to our Investment Edge webinar. We are going to give it just a few seconds to make sure that all of the attendees can funnel in. So stay tuned and we'll get started just in a minute here. All right, I think we should be good to go. Well, thank you everyone so much for joining today. We're really excited for today's session. We have Howard Scharfman and Mark Heppenstall on our panel today, which we'll introduce both of them, but really looking forward to hearing their insights on investments and the economic forecast. So please note that this is an hour-long webinar that we have today, and it will be recorded. And if you do have any questions, feel free to put them in the Q&A section at the bottom of your screen, and then we can address those questions towards the end. So first, I want to go ahead and introduce Howard Scharfman. Howard is our host, one of our panelists today. He is the Senior Managing Director of NFP Insurance Solutions. He is a recognized leader in the insurance industry for over 30 years. He has been recognized by Forbes as one of the top financial security professionals in the nation. He's very involved in the industry, having spoken with the MDRT, Forum 400, and Fonseca. He's also the chair of the Fonseca Foundation and has been the president and chairman of Forum 400. So Howard, I'll pass it over to you, and thank you for joining us today.
Thank you very much, Lizzie, and thank you to everyone who joined us today. You made an investment in time today, and you decided to spend that time with us, and we very much appreciate it. So thank you very much for joining us. Thank you very much for being with us, and we hope to add value to your life today. I am so fortunate to be joined today by a person I could call a friend, a golfing partner, and an advisor. Mark Heppenstall is the President and Chief Investment Officer of Penn Mutual Asset Management. He serves as the President and Chief Investment Officer. He leads the investment team and is responsible for all investment management functions. Prior to joining Penn Mutual in 2014, he served as the managing director and head of fixed income for the Pennsylvania Public School Employee Retirement System. He was responsible for the management of both internal and external fixed income strategies. He has more than 30 years of experience in managing fixed income assets for institutional investors. Very interesting, he has a bachelor's degree from Vanderbilt University in history and a master's degree from the Tepper School of Business at Carnegie Mellon University. He's a chartered financial analyst and has been since 1991. So we're so fortunate to have him with us here today. He's going to go through a presentation, and then we have about a couple dozen questions that we've put together to ask in a Q&A. And then, as Lizzie said, feel free to put any questions you have in the chat, and we'll try to get with them. So Mark, the stage is yours.
All right. Well, thank you, Howard. It is great to be with all of you today. And as Howard said, hopefully it will be educational. Before I kick it off into the presentation, I'll just give a little bit of background about Penn Mutual Asset Management. So we are an institutional investment advisor, really targeting institutional investor relationships. We run about $40 billion. The vast majority of that is somewhat affiliated with our parent company, Penn Mutual Life Insurance. Our core competency is fixed income. That is the vast majority of assets backing our insurance and annuity policies at Penn Mutual Life Insurance. And so we have a terrific fixed income investment team. We've seen growth. We have two external relationships that we've built over the past decade. And we did rebrand to Penn Mutual Asset Management in 2015, so about 10 years ago, and really just wanted to bring the investment manager closer to our parent companies. Clearly, Penn Mutual name carries a lot of weight in the insurance world, but it also does in the asset management as well. So now we can kick it over to the presentation. Right. So I'll start off with just some high-level points on the next page, Lizzie. Thank you. So kicking it off with growth and inflation. I will say the U.S. consumer is one of the lone bright spots in the global economy. And the U.S. consumer has been incredibly strong through really all the time since COVID. We've seen some dramatic changes on the interest rate environment. The Fed trying to basically slow down the economy and in the process slow down inflation. But I will say the US consumer has been incredibly resilient through it all. In terms of the inflation outlook, clearly we have improved dramatically since peaking at close to 9% on CPI in 2022. However, the inflation rate isn't quite coming down to the level that the Fed had hoped to, and their target for inflation is 2%. And last week's consumer price index report came in above expectations. Some of that may be due to some seasonal factors where companies raise prices at the start of the year, but clearly it was still a little bit troubling for Federal Reserve policymakers. So in terms of the interest rate environment, the Fed started to raise interest rates in March of 22, raising interest rates from the 0 basis point level and raising them above the 5% mark. So clearly it was a pretty fast and dramatic move higher in interest rates. And the Fed started to cut interest rates, really feeling that they'd done enough tightening in September of last year. And they reduced interest rates by 100 basis points from September through December. What has been incredibly interesting and very much unexpected within the fixed income world and financial markets broadly, and economists and Fed watchers, is we've seen the long end of the Treasury yield curve do the exact opposite of what the Fed is doing, which is long-term interest rates have now been in the process of rising. So the 10-year Treasury rate was close to 3.5% in mid-September when the Fed started to cut interest rates. Now we are above the 4.5% mark. So again, this move in longer term interest rates really is a sign to the Fed and to investors that there still is some concern about the inflation rate. And they clearly are telling the Fed to be a little bit more cautious with rate cuts moving forward. So I think our outlook is for the Fed to be relatively patient for the foreseeable future when it comes to rate policy. And I will say, after a lot of interest rate volatility since the Fed started hiking interest rates in March of 22, we've kind of settled down into a range on the 10-year Treasury around 4.5%. So again, from a fixed income investor's perspective of the world, I certainly don't mind the fact that we've settled down and interest rates are somewhat holding around the 4.5% mark. So when it comes to risk market valuations, we've seen really amazing demand for credit since the Fed started hiking interest rates. So even though credit spreads are relatively narrow today, if you look at the all-in yield opportunities, just driven by the fact that Treasury yields are so high, it's historically attractive and really the most attractive all-in yields that we've witnessed since the end of the global financial crisis. So again, investor appetite for yields has been very, very robust, and that's really led to credit spreads remaining narrow. In terms of the equity market performance, well, it's been nothing short of extraordinary. 25% plus years in total return for the S&P 500 in 23 and 24. So clearly there needs to be some level of moderation happening within the equity markets, and a lot of that has been driven by hope and expectations around solid earnings from the so-called Magnificent Seven stocks, the large cap technology leaders. We've seen some of the rally start to broaden out a little bit more recently here. So I would tend to say that is a favorable trend within the equity market, because again, I think it's relatively unsustainable to have such a small group of stocks lead the way for the S&P 500. Okay, Lizzie, if you can move ahead. So this is a chart that shows how much the U.S. consumer and consumer spending has contributed to U.S. GDP growth. And you can see it's been a fairly significant contribution to U.S. GDP. And if you look at the percent of consumer spending in terms of the overall economic growth in the United States, it represents about 2/3 of economic growth. So if the U.S. consumer is healthy, chances are growth is going to be positive in the U.S., and the U.S. is going to avoid a downturn or an economic recession. And what's particularly remarkable about these numbers is if you look at where economists were expecting the economy to be maybe 18 months to 2 years ago, the widespread consensus for economists was that the US economy was headed into a recession. They really did expect a downturn to happen somewhat over the near term. And some of that was driven by what's called a yield curve inversion, where basically treasury yields at the short end of the curve are higher than yields at the long end of the curve. And the treasury yield curve has been or was inverted for really a record long amount of time, about 2 years. So again, historically, that's been a pretty good predictor of recessions, but so far we haven't even come close to a recession within the U.S. economy. So again, the U.S. consumer is healthy. We've seen gains in home prices. We've seen gains in the equity markets, all supportive of U.S. consumer spending the past couple years. Okay, we can transition ahead. So the Fed has a dual mandate. It's price stability and full employment. So clearly what's happening within the labor market is part of what's going to determine the outlook for Federal Reserve interest rate policy. And you can see clearly comparing labor demand and labor supply, when COVID hit and basically we shut down about 1/3 of our economy, the unemployment rate in the United States got close to 15%. So clearly there were way more many workers than job openings within the economy. That flipped quickly on its head. And so coming into 2022 and even early 2023, there were way more job openings than workers that were willing to enter the workforce or in the workforce. So the imbalance shifted the other way. And that was part of the reason that we saw the inflation spike. I will say now we are starting to see things normalize. So it looks somewhat normal relative to where we stood pre-COVID. So would say that is good news for Federal Reserve policymakers, likely to be good news for the inflation outlook. And again, I would look at that US unemployment rate, which is about 4% today, as a pretty good leading indicator for Fed policy. So I think if it goes below 4%, chances are no more rate cuts. If we get close to 4.5% on the unemployment rate, chances are we're going to start to see rate cuts again. All right, flipping ahead now. So this is an interesting dynamic that has played out within the mortgage market the past few years, really since the Federal Reserve started to raise interest rates. And it's really had some impact on the mortgage and the housing markets that was, I would say, in some ways, totally unexpected by economists. But you can see, the U.S. Home borrower typically borrows for 30 years fixed rate. So they're pretty much locked into ultra low interest rates because mortgage rates got below 3% level for a while in 2020 and 2021. So that clearly is a huge benefit to the U.S. consumer that has a 3% mortgage, for example, compared to the outstanding rate where we sit today, about 7%. So what does that mean? It means that basically that's almost like a hidden asset on a lot of homeowner balance sheets, but it also means that they're much more unlikely to leave their 3% mortgage and look for an upgrade in homes or even a downsize in homes if they're faced with paying a 7% mortgage rate today. So the amount of new home supply on the market has really been curtailed by this dynamic. That's what's happening within the U.S. housing market. And I will say, the U.S. is one of the few countries in the world where home borrowers do invest. Fixed rate for 30 years is the vast, vast majority of the borrowing within the mortgage space. So again, that's been a great benefit to consumers that have low mortgage rates locked in. but it means there's just less housing turnover happening. And so home prices have stayed elevated just because of a lack of supply. And again, we're starting to see that imbalance start to come back into better balance, especially in some locations across the country. But again, it's something to be mindful of. All right, I'm going to have a few slides on the mortgage market. If you can flip to the next one, Lizzie, thank you. Okay, so this shows, oh, I'm sorry, you can go back again. This shows the homeowner's equity in the real estate market or the home market. And you can see, just as I had mentioned, there's been a lot of wealth creation if you own property in the United States. And I will say, coming out of the financial crisis, everybody said, oh, you shouldn't look at your home as an investment, but that was actually not the case. Homes have been a terrific investment over the past 15 years. So again, that's one of the reasons the U.S. consumer feels so flush, is the fact that they are seeing home prices appreciate, and basically probably their mortgage balances are well below where they could sell their home. And again, the low mortgage rate component of it is another part of it. But again, clearly with rising equities, rising home prices, household wealth is at record highs today. All right, you can move ahead. Okay, so this is one that I think just shows how challenging home purchases are for younger couples that are looking to enter the home buying market. And you can see, look at the average age of the home buyer in the United States. It's risen dramatically from the early 80s, about 50 years old today. So again, if you have a home that's appreciated, that makes it somewhat easier to move today. But if you couple high home prices with high mortgage rates, clearly it's very difficult for first-time home buyers. So we're seeing really a generation of renters arise within the U.S. economy. And clearly part of the American dream is buying a home eventually. But so in some ways, if mortgage rates were to come down, clearly that home price affordability would be helped a lot. And I think a lot of first-time home buyers were thinking at the start of Fed easing and cutting rates that mortgage rates would come down. But again, they've moved in the opposite direction. They got close to 6%, but now they're hovering near 7% today. All right, a couple more slides. So this is one that, there are a bunch of different slides that show just how difficult government finances are becoming in the U.S. and abroad. And some of the troubling part of it is, I think in some ways governments got somewhat addicted to the zero, and in Europe, even the negative interest rate world, and borrowed heavily. However, today, with short-term interest rates about 4.5 and the 10-year Treasury, they did an auction in the middle of February, and they paid about 4 5/8 for their coupon to borrow for 10 years. The U.S. government did. So clearly, the world of 1% long rates and 0% short rates are over. And it really is becoming a problem for the U.S. government. And I think that the interest cost on the government debt is going to exceed defense spending in the U.S. budget. So again, I think in an ideal world, the Fed needs to focus on reducing inflation, reducing interest rates. Also, I would say to alleviate some of the problems that are happening within the government. But I will say we are getting close to the point where I think the bond market may just sort of throw up its arms and say, you know what, we've had enough. And I think that you're starting to see some of that dynamic in play with the rise in long-term interest rates that we've witnessed since September here. But clearly there's a lot of changes happening within the Trump administration. But I do think there's a chance that they're going to have to really focus on what's happening at the long end of the Treasury curve. And it is interesting. Our new Treasury Secretary is actually saying we shouldn't be, is mindful about what short-term rates are doing. Really, we should focus on the 10-year Treasury rate, sort of an indicator of the long-term debt expense for our government. So again, something to watch. And again, a lot of uncertainty playing out with government policy happening today. And the final slide, I think U.S. exceptionalism, is clearly the case with the economy and the U.S. consumer, I would say, in way better shape than consumers elsewhere across the globe. But it's also true for our financial markets. And this just shows how much a part the U.S. stock market has grown in terms of its weight within the world markets, the world equity markets. And you can see we're about half of it today. And that, again, clearly means that our stock market is significantly outperforming elsewhere across the globe. So, and part of that is the large cap technology name. So something to be mindful of. I will say the diversification, which we always aspire to, especially in the world of fixed income, really hasn't been the theme in equities. It's really been large cap tech leading the way, and US large cap tech. All right, so I think I probably went maybe even a little longer than I told Howard, so we'll shift over and go to the questions.
Well, thank you. Mark, that was great. A couple questions I'm going to ask just based on your slides. When we look at the debt, the total US debt, is it important to look at that standing alone for the amount of debt it is, or do we compare it to the amount of debt all the other quote unquote competing countries have? Or is it both that we have to be wary of? Are we in better shape than the other country or most of the other countries, and has that changed in positioning?
Well, that is a very good question, because as you said, especially when it comes to currencies, a lot of the movement in the currency market is driven off of relative goods and bads within the economy and within the inflation outlook. But I will say, when your debt to GDP gets north of 100%, and we're getting there depending on whether you throw in Social Security and some other entitlement spending, but clearly we are getting to a point where I think it's just going to be problematic from an absolute level. And I will say, Japan has been battling this in some ways. They've seen pretty much of a secular decline. Some of that is driven by population growth within Japan. But I do think that we are getting close to the point where the government is really going to have to address this. And I do think, as I said, the long end of the Treasury yield curve may be where you see investors sort of pull back and say, you know what, we're not going to lend you money for 30 years. And again, that's something that the Fed, the Treasury, the Trump administration has to be very mindful of.
Okay, one follow-up question on that. If we don't see the increases in the US equity markets that we've seen in the past, these 25% for 2 years, and that cools down a little bit, do we see some rotation back into fixed income that will help keep interest rates down?
I do think that, I think if you look at like the average weight of the equity exposure in the average person's portfolio, it's probably near record highs. I think some of that is just the sheer appreciation of the equity markets that are in people's portfolio. And unless they're systematically rebalancing, clearly when you have 25% plus years in a row, they're going to have a higher weight within the portfolio. And I will say, that dynamic between equities and bonds, I do think that, bond yields today at 4.5% on the 10-year Treasury, I would say when they were down 1.5% to 2%, they really didn't have sort of that flight to quality type of safety where people could go to should equities start to stumble. However, at 4.5%, I do think that there is a chance, should equity volatility pick up, should we start to see somewhat of a meaningful downturn, then I think you're going to see more people flock to the bond market. I will say that one of the interesting things that's at play, and that's one of the reasons credit spreads are so tight today, is a lot of pension investors, and I worked for a public pension fund in Pennsylvania for 16 years, but basically when you have rising interest rates and rising equity prices, basically your fundedness level goes up substantially because you're using long-term interest rates to discount those liabilities. So I think we've seen a lot of corporate pension funds in particular use their equity gains to buy fixed income. And I think that's one of the reasons spreads are so tight today.
Got it. Okay, well, thank you. We'll get back to some of your slides in a moment, but I want to go back to the beginning. Could you share some of the information about your journey to becoming the CIO of Penn Mutual and the key influences that have helped you throughout your career, has shaped your investment philosophy and your approach.
Well, I will say when I graduated from business school, and I thought about law school that was sort of the 4 years at Vanderbilt, but when I graduated from business school, I got a job at the trust department at the National Bank of Detroit, and that sounds maybe like a sleepy little job. However, the National Bank of Detroit, which has sort of morphed into J.P. Morgan through a number of mergers and acquisitions, they ran a lot of money for the auto companies and for some of the endowments in the Detroit area. So there was a lot of fixed income talent that came out and were mentoring me during my early years in the world of fixed income. And I will say, I was very fortunate to be mentored by them. And I will say, I love fixed income. I know, like I know it's relative to what happens within the equity markets. There are no Nvidias within the world of fixed income, but every day is different. And it just every day is a new challenge. And I have an amazing team at Penn Mutual Asset Management, and so I've been so fortunate with great mentors over my career. And I will say, I think it was Warren Buffett said something like, if you like something and you're reasonably good at it, then don't stray too far from it. And so I still sit on the trading desk today at Penn Mutual Asset Management, and love the dialogue that we have together as a team, just looking at the world of rates and credit and everything in fixed income.
Got it. Okay, well, thank you. So Penn Mutual is known for a disciplined approach to asset allocation. Could you talk about how the company balances fixed income, equities, real estate, alternatives, and how they manage the overall portfolio?
Sure. I will say this one is relatively straightforward. So, I would say there are two primary drivers of returns within the Penn Mutual portfolio. Clearly, what's happening in the world of fixed income is a big component of that. Let's say 85% of the portfolio is in fixed income. So that really is our primary area of focus. Where we have, I would say, another area that is a pretty significant driver is within alternative assets. So that's things like private equity, venture capital, some private debt within the portfolio, and we target a 5% allocation within the portfolio there. And I will say, Trevor Williams and our alternative asset team have done an amazing job sort of building on the long-term track record of success within the Penn Mutual portfolio. And some of these venture capital relationships in particular have been incredibly strong performers over the past, 30 or 40 years. So again, that's a big part of it. We have some real estate exposure, but we don't own direct real estate. And that's a little bit different than some insurance companies. Where we do have exposure to real estate is within commercial or residential mortgage-backed securities. So these are public securities listed, trading actively on a daily basis. But basically, having exposure there allows us to dial up the credit quality up and down, dial the maturity range up and down within the portfolio. So again, it fits in well with our active fixed income management approach. And the equities, it's a very, very small percentage of the Penn Mutual portfolio and really not impactful in terms of performance.
So of the 5% that are invested in alternatives, how does that compare to some of your competitors in the insurance business?
You know what? I think that is very much in line. Sometimes it's hard to get a perfectly clean read on how much exposure some of our competitors have in things like private equity and venture capital. But I think that 5% range is probably reasonable. And I think in some ways, if you look at the trends, some insurance companies have been increasing exposure, and I would say sort of moving up to where we have been over the past decade.
Got it. And any great notable successes you wanted to share in that alternative portfolio?
Well, I will say, and this, I am a corgi owner, and I know you are a dog owner, but we've had some of the venture capital exposures have been huge wins within the portfolio. But one of our private equity companies had started Farmer's Dog or was an early investor in Farmer's Dog, and I know that's what our corgi eats. I will say serving it isn't ideal, but that was a huge win within our alternatives portfolio over the past year. So again, incredible valuation for something that was just probably nobody had ever heard of 3 or 4 years ago.
Got it. I am a customer of theirs, and we like their product, but I understand
Yeah.
the serving is a little different. It's a competitive landscape out there for talent. How do you guys find the best talent?
Well, I do think, one, Penn Mutual has the reputation. I think, the culture that we've created is part of the equation there. And we tend to draw primarily from the Philadelphia market. That isn't entirely the case, but we do have some workers that are full remote as well within Penn Mutual, as is the case for Penn Mutual Life Insurance Company as well. But we had two job openings maybe 6 months ago, one for a corporate credit analyst sort of starting and one more senior position. And we had 300 applicants for each one of those positions. And again, I do think our reputation, the stability of Penn Mutual Life Insurance, clearly plays into that. And I will say we really do try to emphasize not having any super big egos on the team, which isn't always the case with some asset managers. So again, that tends to be, I think, something appealing for a lot of people. And we really do try to strive for a meritocracy where really the best ideas win.
Excellent. Penn Mutual has this rich history. It spans over 175 years. When you look at an investment portfolio and look at what your predecessors have done over the last 160 or so years, how does that affect your decision making?
Well, I guess where I tend to think about the longevity of Penn Mutual Life Insurance Company, I view that as more something that is a responsibility to me. I imagine that the way we're investing in the world of fixed income, I know just in the 30 plus years that I've been doing it, the world has changed a lot in terms of investment opportunities and some of the structures. Some of it is relatively stable as well. Corporate bonds are corporate bonds and treasury bonds are treasury bonds. But again, there have been a lot of changes. But to me, the 175 years, it just, I don't want to say it's a weight, but you definitely think about it. And, I think, and Dave O'Malley says this at, just about a lot of the meetings that I attend, but basically the mutuals, I think, have a competitive advantage of not having to focus on this quarter or the next quarter. We can take a long-term perspective on how we view the world. And I think we've done that with products. We definitely do that on the investment side of the ledger as well. So again, it is a responsibility, I would say, to make sure that we sustain that legacy that Penn Mutual Life has built.
Got it. We see a lot of new entrants into the insurance industry, many of which are private equity backed, and many are using what I would call financial engineering, maybe offshore captives, or what I would call creative structures to boost yield and enhance dividends. How does Penn Mutual, one, think about that and compare with the competitors on that subject?
Well, I will say, the world of private credit, we've been an investor in private credit, clearly not nearly at the scale where some of our competitors on the private equity side of the world have been more recently. But again, I think private credit generally has been basically life insurance, almost disintermediating the bank lending that was happening. And again, in some ways, I think life insurance, because of its longevity, because of the long-term perspective, we're not subject to depositors that can just leave the door tomorrow. I think sort of the time horizons match up well for insurance companies and portions of private credit. clearly I would say the growth there has been significant. Some of the newer entries within the private equity space in insurance, there may be some bumps in the road, but I mean, again, I think, they're smart investors. I think that, I don't view it as sort of a significant problem down the road, but something to be mindful of. And, I think that we are going to stick to our knitting. We can add value in the world of public markets. And, again, we do have portions of our portfolio that are invested in private debt as well. But we just have to make sure that we focus on credit quality and focus on sort of that long-term investment horizon.
Got it. Final simple question on this subject or this topic is it easier to know when and what to buy, or is it easier to know when and what to sell?
That is a very good question. And I've never really sort of considered it, comparing which one is harder. I do think there can be sort of ebbs and flows within the fixed income markets that determine whether something is harder to buy or sell. Like at the onset of COVID, we were flush with capital, so we were able to buy a lot of very, very attractive assets. So I would say it was super easy to buy attractive assets, and part of that was just driven by sort of forced selling that was happening within leveraged players within the hedge fund world and other players as well. I do think, changing that question around a little bit, I think that, when I look back over time where I have made mistakes, I think at times it's saying, if I bought something a year or two earlier, trying to, sort of rationalize why it is still a good investment today. But again, I think you really need to look at the world and re-underwrite every position and say, would I buy this investment today? And if it doesn't meet that hurdle, then you should be a seller of the asset. So again, I think, in today's market, I would say it's probably a little more difficult to buy things just with the spread compression that we've seen. There's just a lot of demand for credit today. So I think, it's very much different than 2020, for example.
Got it. And any market insights that's influenced your investment strategy that's made you adjust your portfolio accordingly, or is it just kind of we have a great system and we're going to keep on with that system?
Well, I do think that, one of the things that we really try to focus on is really the starting point for all our investment activities. We are liability-driven investors. That's why we have such a high fixed income weight within the portfolio. And so we really do work closely with our actuarial team, trying to understand what happens to various components of our liability profile. So we've seen some dramatic changes within our liability structure as a result of the sharp rise in interest rates. So I would say that, the first point of decision making is driven based on what, sort of the information that we're getting from the liability side of the equation. And so, we look for opportunities there. I will say when Penn Mutual issued surplus notes in April of 2021 at a 40-year interest rate of 3.8%, we took some of those proceeds and bought floating rate assets, and some of those have yields of maybe 6 or 7% today. So again, it really is sort of a blend of assets and liabilities and making sure that we come up with the right investment decision.
And Mark, Mutual just sold a major operating asset, which I assume allowed you a significant amount of capital to redeploy. How did you look at that? Was that an exciting day? Was that a stressful day? And how long did it take you to redeploy those assets?
Well, that's interesting. We did, I would say, get an understanding that the transaction was likely maybe 6 months prior to the closing of the transaction. So what that allowed us to do was basically we have a borrowing line with the Federal Home Loan Bank of Pittsburgh. So we were basically able to borrow a good portion of the capital that we knew was going to be arriving in the portfolio in late November. So it allowed us to spread out that level of investment activity. I will say, if you look at the purchase volume that the team initiated last year, it was at a record size versus our previous record. So again, the good news is, because that would have been a lot of capital to try to invest, let's say, for the last month of the year. But again, sort of planning ahead, long-term perspective on things allowed us to do that in a relatively smooth and orderly way.
Got it. So if I look at Penn Mutual's dividend rate in comparison to all of the other major mutuals' dividend rate, it is incredibly steady, and there's less movements than with other insurance carriers. There's definitely less movements on the downside, but just incredibly stable. How do you make sure, one, is that good? Two, how do you make sure, if, assuming it is good, that that continues?
Well, I do think that, especially in the sustained low rate world that we witnessed since the global financial crisis, the sense I get that, financial professionals really appreciated the fact that Penn Mutual did their best to keep their dividend stable. And I will say the fixed income team has worked hard. That's part of the equation as to why we were able to sustain that dividend level, even in the world of prolonged low interest rates. And the active management approach that we take within the world of fixed income allows us to deliver returns historically well above just a passive holding of fixed income assets within the portfolio. And if I look at the transaction or the transition that we did from the low rate world to the high rate world, we had significant floating rate assets within the portfolio, and these were resetting to higher yields every 3 months. So that was a huge tailwind when rates were rising, and we had some money that was tied up in fixed rate and longer term. But again, getting that boost in income within the portfolio from floating rate assets at that point in time was a huge win for the portfolio. And today, with the yield curve beginning to steepen some and low rate and short-term rates begin to decline, we're actually transitioning away from floating rate assets today and looking into lock some of these attractive all-in yields that we're seeing.
Got it. Got it. And are you looking outside the country more into the global world? Specifically, could you share any regions that you're looking at that are more promising than others for investments?
So we are very much U.S. focused in terms of our investment portfolio. We have, small weights, very small weights relative to peers, especially in things like emerging market debt. And I will say some of that was just driven by the fact that, especially when you look at interest rates in Europe, spending a prolonged period of time in negative territory, created, I'll say, some distortions that were happening within the fixed income and credit markets over there. But, we are very much U.S. centric within the Penn Mutual portfolio.
Got it. And with the change in Penn Mutual's sales from primarily a life insurance company to now a life insurance and annuity company, has that changed your need for liquidity? Has that changed the way that you invest the assets? And do you invest the assets in the life insurance portfolio different than in the annuity portfolio?
Well, we do look at the portfolio holistically, and so that, and we haven't sort of segregated any legacy blocks of business. We want to make sure that the whole Penn Mutual portfolio is structured in a way that's going to serve all of our life insurance holders, all of our annuity holders. There are certain products within the annuity space that are more driven off of levels of interest rates that we can lock in today in the world of fixed income, as opposed to, I would say, life products that tend to be more long-term in nature. So again, it really hasn't changed things. As I said, the duration of the portfolio has changed somewhat over the years. Some of that was driven off of the interest rates moving up and down. Some of that was driven off of the balance of annuities and life. But we've always had some balance there between annuities and life. And as you said, the past couple of years, annuities have, taken the lead, at least in terms of the growth of our business.
Excellent. You spoke about Warren Buffett. You also spoke about the trust department where you started your career. Have you had any other mentors that have really shaped your view of investing, that you follow their kind of rules of thumb more than others?
Well, I will say, I'll give you a couple. And one of them was at the Trust Department of National Bank of Detroit, somebody named Doug Swanson, and he never got the level of notoriety that Bill Gross or some of the other sort of legendary investors in the world of fixed income. But his track record was, especially through the financial crisis, as good as anybody. So Doug retired 3 or 4 years ago, and again, his role had morphed into managing funds and strategies at JP Morgan Asset Management. And the other, the 16 years that I had at PCERS, we ran money internally. So I had an internal team that was running fixed income money. But we also got a lot of exposure to, I would say, the brightest minds of fixed income, the brightest minds in equities, the brightest minds in private equity. So, when you're part of a $70 billion public pension fund like that, you get a lot of exposure to, I would say, leading edge investors and institutional investors. So again, that time there was educational on a lot of different levels.
Excellent. We have many financial security professionals on the line here. If you had some advice for them when they get into a conversation with a client who says, I can invest my money better than Penn Mutual can, and thus I'd rather invest my money than put it in, let's say, an overfunded whole life insurance policy or index universal life insurance policy, could you give them some battle-ready statements that they could use to convince that individual that no, an allocation inside of some of our very special products is where you should be allocating?
Well, I do think that if you look at, the returns that you've been able to get in some of our life insurance products, the whole life, some of the IUL strategies, in some of that also in terms of, protecting those that count on you, the next generation, there are parts of life insurance that are invaluable. And I know if I look back on it myself, as soon as I got married, all of a sudden I started looking at life insurance. So I think that's sort of a key component of every portfolio, and having that level of diversification with life insurance protection first type component within the portfolio, I would say allows you more freedom within other parts of the portfolio. So again, I think if you look at the whole investment program holistically, I think life insurance is a key part of that.
Okay. And as we come closer to our end of our program today, what advice would you give a young financial security professional if you had 10 minutes with them?
Well, I will say one of the themes, and it gets back a little bit to the previous conversation as well, but one of the themes that we really do emphasize is the diversification is the best form of risk management. And, I think that is true for all financial professionals. And I do think that, there are so many people in our country that really need financial advice. So I think you are offering a very valuable asset. And, I would say, especially if it's a younger person entering the business and, maybe they're dealing with younger clients, but, the ability to have 20 or 30 or 40 years type of investment horizon is a huge benefit. So I really think that, you need to develop the plan, stick to the plan. You're going to have ups and downs. And I know my kids often call me and say, Dad, the stock market's down 10%. Should I sell? I'm like, no, stick with the plan. You don't want the stock market just to go up every day. So again, I think, again, the advice that is being given today to me is highly valued for so many people in our country.
Excellent. I think that would be very helpful. I imagine you would add, it's better to pay less in taxes than more is a.
Yes, that is very true.
Very good. Just two quick questions in closing. One, any predictions on where you think dividends are going in the next few years? Just between us group here.
Well, I think if I would say can be sustained in, I would say in that 4.5% to 5% range on the 10-year note and higher for a couple of years, I think that is likely to lead to an upward trend in the direction. Clearly, if the Fed continues to lower interest rates at the front end of the yield curve, that may offset some of the benefit there. But again, I think that portfolios are all sort of gradually readjusting to the higher interest rate world that we reside in today, which I would view as a benefit longer term for the dividend.
Okay. Well, thank you. And Mark, in closing, any other advice you have for our audience, either on investments, on life, or on general insurance?
No, I don't think so. But I do want to thank you, Howard. I really appreciate the opportunity to spend time with you here today. Your team has been amazing in helping me get prepared for this presentation. So I think this is my first official podcast. So again, I'm over the hurdle now. So thank you for getting me there. It's been great to work with all of you.
Excellent. And hopefully all of our people online here with us today could send this and make it viral so you could be known throughout the world as the investment professionals you are. So thank you very much, Mark, for your time. Lizzie, thank you for all your work in putting this together. For everyone on the line, thank you so much for investing your time here today. You had a lot of choices. You chose to be with us, and I very much appreciate that. And have just an amazing, super fantastic day, everyone.